there is definitely some economic headwinds for the average American. There is no doubt in my mind that it is happening, right? You know, the first of all, the CPI report came out on Thursday, yesterday. It went down, actually, it went negative. So inflation, according to the Fed now, I'm not saying it is happening. According to the Fed, it's not that we're experiencing on our everyday life. According to the Fed, CPI is under control. In fact, it went negative, meaning it's contracting to the level at 3%. Now, Fed is saying it's 3%. Do you all believe it's at 3%? I don't think so. I think it's a lot higher than that. There's data out there that proves that. But, the CPI is figured out in a very kind of a weird way. I'm not going to, discuss what the Fed is doing right or wrong. I said my piece on that multiple times over the last 8 weeks that the channel has been around. So CPI was good, but today PPI, Producer Price Index, came out, and that did not confirm the CPI. Basically, CPI and PPI are running around 3.5% per year. That has been the case for the last couple of years now, right? So basically, either the Fed is massaging the numbers, which they don't have to do any of that, obviously, but then the basket that they create the CPI from is kind of flawed, right? Most of the time they come and say, well, CPI is down 0.1% for the month and 3% only for the year, which is contracting from 4%, 5% levels, without food and energy. I'm like, who doesn't eat, who doesn't buy gas? But let's just go with that. However, what's happening in the background is that, this actually kind of may force the Fed to get behind the curve, right? I believe they're behind the curve by cutting rates, because the GDP is slowing down. Gross domestic product is slowing down a lot faster than they think it is. And this is from their, Atlanta Fed. GDP growth estimates are plummeting. So what happens? Our GDP depends, or 80% of our GDP is consumer spending. Okay. When consumer spending slows down, people start using their discretionary income more carefully and start saving some money. As we know, savings in this country is nowhere. It's horrible. So what's going to happen is that GDP is going to slow down because we don't have manufacturing. Okay. What we have is consumer spending money on credit cards and borrowing and spending, just like the federal government does. So when that happens, watch out, right? Then the Fed is definitely behind the curve in cutting rates. So the most recent Atlanta Fed estimate, so as you guys know, there's different Feds, Atlanta, New York, Cleveland, and in different areas, there's Federal Reserve branches, let's say, under the guidance of Chairman Powell, right? So there are Fed governors in all these cities. The most recent Atlanta Fed estimate for the real US GDP quarterly growth in Q2 2024 is down to 1.7%, as you guys can see in the big red oval on the right-hand chart. So GDP is clearly slowing down, right? And when GDP slows down, consumer spending is going to slow down, and the economy, the soft landing that the Fed is trying to accomplish may not be in the cards, because the market is definitely pricing in a soft landing here. And this estimate is down from 4.2% seen in mid-May, from 2.2% seen in June. So GDP was doing fine until the high interest rates that the Fed had to implement to kind of cool inflation off. There's always a lag between high interest rates and what kind of damage it does to the economy. Well, we're seeing it now. Now GDP is definitely slowing down, and that's why I said on a different video, actually today's video that came out, is Fed behind the curve. Behind the curve means they're always late raising rates and they're always late cutting rates. So were they late raising rates after the pandemic when they printed $7 trillion and pumped it into the economy? Absolutely. They let the rates, the ZIRP policy, zero interest rate policy, too long. And that created the inflation that we're experiencing over the last 2-3 years. And now they were behind the curve then. That's what it's called. And now they're behind the curve again by lowering interest rates, because GDP is really slowing down really, really fast. And but the Fed is saying, no, we're going to wait until inflation is down to 2%. If they wait until inflation is down to 2%, we may be in a full-blown recession. but that's why I'm calling him behind the curve. However, after yesterday's CPI report, the likelihood of Fed lowering rates earlier than November, because they had said they're going to do it only once this year, actually it may be twice this year, they have to start cutting rates. The other thing is, our debt, right, 35 trillion, which is going up a trillion every 100 days, the servicing of the debt, actually, as of today, I couldn't put that in yet, but I'll talk about it next week. This year's just the debt servicing is up to $1.14 trillion, just interest we're paying. So who needs lower interest rates more actually than the government itself, right? Because during the pandemic with zero interest rates, our debt servicing was 400 billion. Now it's up to 1.14 trillion, right? So that's actually an anchor to the economy as well. So, I mean, the consumer needs lower interest rates. Obviously, we know what has happened to our mortgages, car loans, and credit cards, and all that stuff when they raise the rates from 0 to 5. Well, the consumer needs it. The economy needs it in order for the GDP not to go, to soften up some more. And more importantly, the federal government needs it. The government needs lower interest rates more than anybody else because of the deficit that they're running at 35 trillion now. This estimate is down. So if this estimate turns out to be correct, which again, this is from Atlanta Fed, this is only one section of the country, because other sections maybe just kind of leveling the GDP estimates to a higher level. If this estimate turns out to be correct, it will be the second consecutive quarter of GDP growth below 2% after Q1 2024 GDP of 1.4, as you guys can see on the right-hand chart. So economy is definitely slowing down. And since our GDP is made up of 80% consumer spending, if the consumer slows down, not stops, obviously it will never stop, but if they slow down spending, the lag effect of 5% interest rates may be just on display here. So I'm again, I think the Fed needs to cut rates sooner than they said they will, instead of waiting for inflation to go to 2%. And the other thing that's happening is unemployment actually just cracked 4%, first time in a while. But we'll see. I'm definitely calling that the Fed is behind the curve. They were behind the curve raising rates, and they're definitely behind the curve cutting rates.